Welcome back, everyone. In this video, I'm going to be going over SCHD and its recent decline, and also whether or not you should be buying this ETF in 2025 and going forward. Now, I do own SCHD, and I continually buy it bi-weekly when I receive my paychecks, currently at about 724 shares, which has a total market value of about $20,000. I do think SCHD is a great dividend ETF, and it can be a staple to any dividend investor's portfolio. With that being said, the ETF is down approximately 7% over the past month, so this has a lot of dividend investors of this ETF worried about the future of this ETF going forward. Should they sell it? Is this still a good buy? And is it going to go up in the future? So to answer the first question, why is this ETF dropping and going down in price over the past month? So in all, the total market is going down pretty much. So if you look at the Vanguard S&P 500 ETF, an ETF that tracks the 500 largest companies in the United States, it is down about 3% the past month. So not only is SCHD down, but you have to remember the total market is down itself. Of course, SCHD is down a bit more than something like the S&P 500, but when you take a closer look at SCHD, you find out the reason why there is a discrepancy between the drops. When you look at the industry breakdown of SCHD, you see that the top three largest industries that this ETF holds are financials, healthcare, and consumer staples. And what you find is that these industries have all gone down more than the S&P 500 over the past month. You have the financial sector going down, which is the largest holding by weight, by approximately 5%, and I'm simply using the Financial Select Sector Spider Fund XLF as a surrogate just to kind of give an example. But you do see that this largest holding did go down more than the overall market, and you also see that with healthcare and also with consumer staples as well. And of course, you also have other industries that are weighted above 10%, like energy and industrials. But even looking at something like energy, you see it down approximately 10% over the past month. So it's no wonder why, if this ETF's industries are down, this ETF, of course, would also be down as well. And should it really concern you that this ETF is down over the previous month? And I would say not so much, of course, because that is such a short time frame. It is basically irrelevant on the grand scheme of things. And I think most people would also say that none of these industries are going to be going anywhere anytime soon. They're all extremely valuable to society for one reason or another. And given enough time, these industries will certainly come back. Don't base the performance of these industries or even this ETF just on a month. And after all, SCHD all in all does hold some very solid companies in its top 10. And given the top 10, I don't think these companies are really going anywhere anytime soon. They are some of the largest companies in the United States, and they have consumers using these products and services daily. Now, if we expand our timeline a bit, again, don't look at just a single month, because as you can see, overall, the previous year, the ETF is up around 7%, and it was going up and up and up, and at a certain point, it was up about 16% or so, and that is without that dividend reinvested. And this ETF really isn't meant to grow too much in capital appreciation. It's meant to grow dividends over time and also pay a decent dividend yield. So it's no surprise that people may be taking gains in some of these sectors or the ETF as a whole. I mean, the ETF was on a tear, and you generally don't see an ETF like this up 16% just in capital appreciation in a single year. So I don't think it is unreasonable that this ETF did drop in value. Now, given that the ETF is still up at about 7% here. Now, as pretty much every investor of this ETF already knows, this ETF is designed to track the Dow Jones US Dividend 100 index. So we can actually look at the historical performance of this index and see kind of how this year's performance comes in compared to previous year's performance. And if we look at the annualized performance on average of this ETF over the past 10 years, it has a price performance, simply price performance, this doesn't include dividends reinvested, of about 7.4%. And this is only slightly off currently from the prior year's performance of 6.9%. You're only looking at about a 0.5% difference on average annualized return. So that's really not such a big deal. This is pretty much right in that standard deviation of the average right there. So the fact that this ETF only went up 6.9% this year, it is practically right along average with the prior years as well. So really not too big of a deal with that. And honestly, if this ETF didn't have such a hard recent decline, we would see that price return right along within the average range. So no concern there, and nobody should really be too concerned about that. And pretty much the overall market is up about 24% just in price return over the previous year. So the market is very hot, and I don't really think it's unusual for some taking of gains to be taking place, especially because the prior 6 months we did have some extremely quick run-ups. So I don't really want people to get caught up in the performance of a market over a month-long period. It's just pointless. These things generally average out over time, and simply drops like this aren't really all that concerning. And we also have to contend with the fact that in 2025, the Federal Reserve is not expected to cut interest rates more than just twice over the year. And a lot of people were thinking that there were going to be multiple cuts, but now the Fed is only projecting just 2. And as the Fed cuts rates, equity prices are seen to increase over time. Now, we got news that the Fed wasn't cutting rates, so the market reacted to this, and there was a bit of a sell-off through December. And this is going to impact things like SCHD even more, because when the Fed cuts rates or increases rates, it is not only going to increase the cost of capital for capital-intense industries, which a lot of dividend stocks are. A lot of the companies that pay dividends are relatively capital-intense, so that cost of borrowing goes up when interest rates are increased. And also, it also plays on the overall fact that it also impacts things like the risk-free rate of return over time. And basically, why would somebody want to invest in a dividend ETF like SCHD, where they can get a great yield with basically no risk by just buying a treasury bill on itself? So that definitely impacts the price of things like SCHD and dividend stocks in general. At the end of it all, SCHD still remains one of the best dividend ETFs you can buy, in my opinion, and I am still buying it. And I think going forward, you can still buy it too, as well as I, because it is really not going to go anywhere anytime soon. And as I already stated, this previous 1 month is not something to base the future performance of this ETF off of. It is pretty much right in line with the average historical annualized performance. Let me know in the comments section below if you are going to continue to buy this ETF going forward. I want to thank you all for watching, and I'll see you all in the next video.